When's the last time you spent time in a sauna?
Long enough that I can't remember. How about that?
Yeah, same here. I can't remember either.
But Victoria has at home, she has a what would you call it? I guess like a portable sauna?
Yeah, like the one that's just standing free outside of your house?
No, no, no. This is one that like collapses into like a sheet of paper and you uncollapse it and it becomes like a little cocoon and you zip it up and you sit in there and your head's sticking out and it's got remote control and plugged in electric. I've used it a few times. It gets very hot very quickly.
That sounds dangerous.
No, it's perfectly fine.
How hot can it
It's
get?
just heat. It gets hot. I mean, you're sweating in 10, 15 minutes. And we put on a episode of Suits last night. We watched it together 45, 42 minutes or so. And she sat in there the whole time. And instead of paying thousands of dollars, you spent a couple $100.
Wow, there you go. That's sauna.
Okay, let's begin. Welcome, ladies and gentlemen. Episode 69 on July 1st, 2025. We have some exciting news, Marcos. The birds are singing, beautiful sunny sky out there. And it's not what you think. It's not because the Panthers won the Stanley Cup for the second year in a row. Vamos Gatos. I got to see it live. That was pretty impressive. It's because the stock market closed on an all-time high yesterday. First quarter was fantastic.
Incredible.
So we're going
What
to
a
talk.
recovery.
What a recovery. We're going to talk about the recovery first, get out of the way, about what's happened since February 19th. So since the 19th, we had hit in early April about a almost 20% decline from February 19th. We're
Are
now,
you calling it a bear or not? Are you calling it a bear or not?
well, it wasn't technically a bear.
I
The
know.
Nas-
Yeah, let's agree. It wasn't a bear. Okay, go.
The Nasdaq was down more than 20, but the S&P was not. And since then, we recovered all of that. Growth and value have both recovered. However, one surprising thing is that many of the Magnificent Seven stocks have not recovered. So while Microsoft, Nvidia, Meta are positive, other things like Apple, Tesla, and Alphabet are not positive. I know a lot of clients have been asking, what caused this? I want to hear your reaction in a second, but my quick take on it is that it's not been as bad as we thought. The data keeps coming out decent, right? We've got decent jobs numbers, decent inflation figures. We're starting to negotiate with some countries and back off some of the tariffs. So every month that goes by where it's not anything bad, it's sort of a sigh of relief. Interest rates have come down a little bit, not heading towards the 5% number that they were earlier in the year. So I think just we've really looked at it and said, while things could get worse going forward, certainly tariffs can come back. It's not been horrible, and it's actually been we've been led by some surprising companies, not the Tech Seven that's always been leading things in the past, which is good. You got breadth of earnings.
Yeah, so the 493 looked good, which is awesome. Um, Eventually, I don't know how or when, the 493 are going to benefit from the AI trade just like everybody else has, because that's unavoidable. It's a la Thanos, inevitable. What 493 catch up and take over, I have no idea, but they're going to benefit because what are you going to trust the biggest companies on the planet to do? To innovate and move with the cheese. The seven and the dispersion of performance there, I love seeing it because it's hopefully the market kind of picking winners and voting on their spending. So their capex is astounding and surprising to see. So hopefully the market's letting those companies know what they like, what they don't like, and they'll have to compete. And so I think finally there's some competition showing, and it isn't just one big, broad, buy an entire row of businesses. You're getting some selectivity, which is nice. And then, yeah, the 493 showing up is very, very helpful.
Do you know the stock that's up the most since February 19th? Probably the one you'd least expect.
Monster Energy Drink.
Dollar General, up 50% since February 19th. So, dollar stores. Industrials lead the way in terms of the sector, and stocks are up a lot. So, yeah, breadth is good. More companies making money, not just relying on the same seven stocks. You have a chart also about the recovery that you want to share?
So, mine pairs with something. So, the chart that I have here is just showing the last handful of stock market pullbacks, and they've been followed by these just gangbusters recovery. This one being the most expeditious of them, which I thought was surprising given the COVID rally that felt pretty damn quick. And the reason I brought this is because what always happens when you get these all-time highs is folks see this new all-time high as a top and think, oh gosh, it can only go down from here, or this is definitely not the place that I want to invest. And we're up, call it 25% or so off the lows. And when you look at this chart, what it's telling you is there's plenty of room to run if you're looking historically. And then I'll couch that and also reminding everyone two things that'll come to pass at some point. Regardless of your political tilt, eventually the data is going to tell Jerry Powell and company to cut interest rates. When they cut interest rates, the $7.5 trillion sitting in money market funds is going to have to continue making the decision to stay in money market funds or go and find a better expected rate of return. And $7.5 trillion is not going to find their way into the market, but I bet you some will. So given what the data is, given that the Trump tariffs always seem to be much worth on the tongue and then much easier on the result, we could just get an absolute just takeoff point from here over the next 12 months. So that's just kind of my observation.
I'm taking all my money out of money market, putting it in crypto, as we've discussed in plenty of past episodes.
Finally.
Yep, I'm on board.
Finally acquiesced. Now that, ladies and gentlemen, is how you call a top.
One comment I've heard from a lot of people is that it's so crucial when you put your money into the market. It's so crucial when you get invested. I completely disagree with that comment.
Timing?
Yeah, timing, if you've got a sale of a business, a sale of a property, you're getting in for the first time, you inherited money from a family member. I hear people say it's important that I get this right because I'm going all in. Do you remember when you first put money in where the market was? Does it really matter if you get in now or a couple thousand points lower? Like in 20 years, we were talking about Dow, 100,000, Dow 200,000. Like it's not going to be a thing. Who cares if you got in Dow 50 or Dow 40?
Yeah, look, while I agree with you in principle, I will tell you just because the practical reality is we have plenty of clients with have plenty of different of inception dates, and their average annualized returns decades in are impacted by the start date.
Of course, but it's not that they had any knowledge where they would have said, "Oh, I wish I had done it like that time." You don't know. You put it in when you get the money.
Yeah, no, I hear you, and then you're kind of left on the whims. Here's what I'd say: look, if the contribution you're about to make your portfolio is the last one, okay, I can understand why timing is going to be more important to you and more top of mind. If the contribution you're about to make to your portfolio is not your last one, it matters much, much less.
Like a realtor, it's always time to get into the market now because over time markets rise. So it doesn't help waiting unless you're trying to minimize regret, which we've talked about. Like that's a viable reason to wait. Otherwise, just get the money in.
Timing it using the win patterns is no bueno. You can have a thoughtful way of getting into the market that is solving for regret minimization without doing a lump sum.
Shout out to Steve Foldis. It's not timing the market, timing, it's time in the market.
I think Aristotle said that, dude. He's just the oldest guy here. That's why he gets credit.
We have seen a lot of clients talk about depending on what side you're on, they either love what Trump is doing or they hate what Trump is doing. And it's causing them to have an effect on their investing philosophy. So I got two charts here. The first one is showing some of the Republican-led ETFs that have sort of the performance of the last few years. And the line that I want to read, let me pull that up, is that funds including the American Conservative Values ETF and Point Bridge America First ETF, which goes by the ticker MAGA, has drawn tens of millions of dollars in assets. Both of them one of them has tracked the S&P performance over the last 3 years. The other has lagged behind it by more than 20 percentage points. So if you want to go all in on, a Republican being in office, and so you're going to buy a Republican-controlled ETF, not seeming to do so well. And the other thing was that if you look at who expects stocks to go up over the next 6 months, obviously Republicans are much higher than Democrats. That probably switches around 4 years from now. But what we've seen is that over time, no matter who's in office, as you said, markets go up. And to be betting on what the president does is kind of foolhardy. It's not a good strategy. Just go with
Terrible.
the S&P, own it all, and you'll do better than trying to be all red or all blue.
Terrible. Everyone should be able to look at themselves in the mirror and realize that when their person is in the White House, they feel better and vice versa. It's just so funny how 12 months you get some one side of the aisle screaming at you, and then it just flips immediately.
People need to stop. So here's one cool stat. If you had invested only $1,000 upon Dwight Eisenhower's inauguration, in 1953, and only held that money when a Republican was president, you would have $29,000 today.
How much
If
did you
you
start
own
with?
$1,000
Okay.
when Eisenhower was inaugurated, you'd have 29,000. If you did the same thing when only Democrats were in office, you'd have a little more than double that, because Republicans did have some bad times with 9/11 and other things.
Yeah.
Simply buying and holding the S&P over that entire period of time, $1.9 million. People, stop making decisions on red or blue.
I know, but every single Dem is gonna do a victory lap on that stat, man.
Neither one is a good decision.
I know, but it's relative. It's not relative. Neither of them are gonna compare to all time. That's funny.
Yeah. I don't want 58 grand. I want 1.9 million.
No, I know.
What you got?
That's so good. I'm gonna say it one more time. $7.5 trillion in money markets. Good Lord. Alrighty. So one of the things that's been keeping the market up and has been one of the talking points that you probably have to read a little bit beyond the first or two headlines on whatever financial publication you read is just corporate margins and how wonderful they have been. And with this new world that we're ushering in, that is going to be reshoring and onshoring some items, and perhaps bringing manufacturing from different places to more onshore, so to speak, margins become a question. And these two charts are going to give you a sense that I would have told you, yes, this makes sense. Cost of goods sold as a percentage of sales has come down. Pretty incredible. Look at the China boon, right? Again, China has been just crushing it for 25 years. You're welcome, China. And it's also been good for corporate margins for obvious reasons. I like how this chart also then went one level deeper, because in my mind I'd say, well, that is the S&P 500. You know what's happened in the S&P 500 over the last 25 years? The percentage of the market cap is more technology oriented than it is manufacturing or hard good oriented. So that's probably a natural decline, except for the fact that when you look across sectors, you see that the cost of goods sold as a percentage of sales has improved materially across sector. So I bring this up just to say I wonder what the impact is going to be to margins, and is it going to be on a scale of no impact to catastrophic? I guess if I had to bogey it, I'd put it at down the middle to maybe even like a 4 on that 1 to 10, where it's not going to have as large of an impact as we think it's going to, because I'm going to bet on the biggest, most successful companies to pivot appropriately.
Agreed.
I just think that that's going to be a massive story moving forward, and one of the reasons that you could see a big swoon in markets is because margins get eaten away.
I mean, it's been a story, right? This chart doesn't suggest it's been a massive story. So if I had to then predict the future, I'd say it will continue to be a story, but not a massive story, and that it will improve over time for most people, right? We do know of industries, of companies that are just being hammered right now or benefiting extremely well because they just haven't been in the right place at the right time. So it depends on the industry you have and what you're actually importing and where you're getting it from, and whether you're in the crosshairs of the president and his cabinet. But for the most part, I think it's only going to get better going forward, because that's what happens. I mean, this morning they were showing videos on the Wall Street Journal about Amazon's factories and how many robots they're using, and they're now picking stuff off shelves, and there's more robots than people now in Amazon, right? Like, that's nothing to do with cost of goods sold per se, but just showing how over time they're going to get this thing figured out and find a way to make it cheaper and cheaper.
Well, yeah, I think it does have something to do with cost of goods sold, because you're reducing costs by employing a robot instead of a person. So
Well, they're paying the people a lot more to monitor the robots.
I hear you, but it's less people, right? So I think your overall cost, like the overall nut, is going to be lower. So I'm not worried about Amazon per se. I'm worried about entire markets and like how much does it erode away? I'm not sure. I think 13% is the contribution of margins to earnings, something like that. So it's not immaterial. For me, here's what I always tell you, and I think, I always say this, the more the margin story gets top of mind for everybody, the less it'll actually be an issue. So this is me trying to do my part to make sure everybody knows about it. Because if you call out the cards, they're never going to be there.
Well, if that worries you, what worries me is interest rates and the debt of this country.
Ugh.
So segueing over to that, it's been in the news a lot. We got downgraded a few months ago by one of the rating agencies. Thankfully, interest rates have not spiked since that time. They're actually a little bit lower.
Done the opposite, baby.
So I've got 3 charts here, but I was surprised at a couple of them. Number one, who holds U.S. Treasury? So who holds the U.S. government debt? More and more debt, that means more and more interest payments going out to the debt. You can see that foreign holders are owning a lot less of our debt. You could say that's a positive thing because they have less control over deciding we're not going to buy your debt, or you could say it's a negative because that eliminates some of the demand from the debt. So that's one issue. Number two, the gap between federal revenue and spending is the largest it's ever been. It doesn't look like this new bill is going to do anything to help it because now they're talking about a couple of $1 trillion in more in deficit. Although some of it was just a continuation of old deficit policies with cutting taxes and having more deductions and so forth. And then finally, the long-term interest rates doesn't appear like they're going to go down anytime soon. They're hovering a little bit over 4% for a 10-year, over almost 7% for a 30-year. That's affecting your mortgage rates, your car rates, your credit card rates. You've said it before, if it hits 5 or keeps going up, that's a huge concern. I think it's a two-headed, two-sided coin here. For consumers, higher interest rates is good, right? Because you get to buy your bonds and get a higher interest rate. On the negative, the more the government pays for interest rates, the more they're going to have to cut somewhere else. Otherwise, we're going to be in this situation where it's just can't continue.
Yeah, I don't even think higher rates are not, especially in the short term, not better for consumers.
If you're buying as a buyer, not of a loaner, of a buyer of bonds, certainly is good.
Yeah, that's specifically looking at bonds. But if you're looking at everything else, higher rates ultimately stampede folks wanting to do stuff. So you're just going to get more action once these rates start coming down. And again, the data's there. Now everyone's wondering if Jerry is just a political tool. I think he's just hedging for he's done in February, right? He's out in February?
It's sometime next year, yeah.
So he's almost out. He just doesn't want to be the dude who let inflation come back, right?
Yeah, but you made the argument lower interest rates for money markets going to push that money somewhere else. If you have higher rates on bonds, a lot of it can go there, right? That's a direct competition against stocks.
A lot of it goes to bonds, exactly. Look, we're already there. But if you get rates that drop, and I'm sitting in a money market fund, that 4 handle. Once that 4 handle disappears, because you're still getting paid over 4% to sit in a money market. Once that 4 disappears, then I think you have more motivation to go look at a corporate bond fund or look at a stock fund.
Well, maybe somebody will get us back to balanced budgets.
All right, last one. Oh, just on a high note, it's great to be in America. 4% of the world's population lives in the U.S. We get to be part of that 4%. So do my kids. That's awesome. What a treat. Best country in the world. And on that note, this little chart from Bespoke Investment Group is telling us that, and we're looking at the average performance by month, July is an absolutely wonderful month since 1945 for the market. And it's actually the most positive month from a percentage of the time positive perspective. So here's to July.
Here's to the reason why I'm going on vacation for 2 weeks to the Midwest to see clients and to get out of town, because market will be positive. No one's going to call. No one's going to complain. It's all good.
It's the best, man. What a treat.
September, don't go anywhere.
Yeah, no. Not looking forward to September, but it's fine. We have July right now.
But if September was bad every year, then you would simply sell in August because you wouldn't want to wait till September because September was already falling. And then people would start selling earlier and earlier, and eventually they'd be selling in July because August was bad because people knew September was bad. So you can't rely on this every single year.
Yeah, that's good. Check this out. So historically, when the S&P posts back-to-back monthly gains of 4% or more, or even just a 4% gain in June, its performance in July has far outpaced the average for all months since 1945.
Let's go. All in.
Wow. Look at that.
Do you know that reference? All in?
Yeah, it's a podcast. It's a poker thing.
Well, it could be. It's also a Jeopardy thing. James Holzhauer, who was one of the most famous Jeopardy on his daily doubles, would go all in.
Wow, incredible. It's awesome. We just lost a viewer. It's incredible.
What game? These people watch Jeopardy. They're brilliant. Our followers are brilliant.
All right, Horowitz. Thanks for the day.